Hey traders, Stephen Kowitzel here. It is Wednesday, midday, kind of middle of the week. The market is, looks like it could be coming back. So I think where the market finishes is pretty important today. If we kind of look at the Russell, it's kind of trending down, but we'll kind of see the Dow is coming back. So we're going to look at a lot today. This could be a little bit longer of a webinar. Just because I have so much to cover and I didn't do one last week. So there definitely is a lot I want to cover. Real quick, before I get into the S&P 500, I wanted to remind you, there is a huge 5-day event for Wealth 365 starting January 21st. I am speaking at that event, and this is really 70 speakers of some of the biggest publishers and financial minds in the world. This thing is absolutely huge. Hence, there's, jam-packed 5-6 days worth of speakers. So if you want to register for that, I highly recommend it. That starts Monday. You can go to go.wealth365.com/the-traders-plan, and I'll put a link in the email and in the blog post. But I highly recommend you checking this out. If you can see what presentations are pertinent to you. A lot of great information. I love these things. I love listening to the different speakers and their ideas and thoughts and how they trade. So check this out. Go and register for this event. I promise you, you will not be disappointed. Let me kind of close out that. So let's start with the S&P 500 real quick. I want to update that. So, we're at a critical point right here. You can see that I drew this resistance support line. You can see that it turns green when it's support and turns red when it becomes resistance. So this was right around 2620 is where we're at. You can see this support line was touched 1, 2, 3, 4 times. And then it broke, okay? So what typically it was support turns into resistance and vice versa. We are right at this line, and the 50-day moving average is kind of all coming into this resistance. You can see right here that the last 2 times the S&P 500 tried to clear the 50-day moving average, it got rejected. Now this time could work. It could pop above it like the NASDAQ already has and then go back below it. But, right now what I'm really looking for is if we do, this has been just a huge surge. And if we do get, up in this area, up in this zone, you can use, and then we get that double test, right? That double test that typically always happens during market corrections and bear markets. If it hovers a few days above the 50-day moving average and then closes back below it, you can start to take some profits, raise your stop. If it falls below this up curling 20-day moving average, I would definitely protect yourself and get out of the way for a potential retest. You don't know if it's going to undercut it, if it's going to come down here, if it's going to come right here, or if it's just going to go all the way down, if that happens. But we are at a very interesting point right here. And you can see really this washout low, lots of distribution, hasn't been a ton of accumulation on the upside, which there doesn't always have to be. I notice there's typically the market can still head higher. But if I were to, so we're kind of at double resistance with the S&P 500. But if I were to, let's throw a Fibonacci retracement on this. I didn't want to make the chart too ugly. So you can see right here that at the 2640 level, approximately, the S&P 500 would be at a 50% retracement, okay? So you have, and then it can get all the way up here for that 61.8% retracement of this measured move. So, we are at a potential resistance that was 4 times support. We're at potential resistance at the 50-day moving average that rejected the previous 2 times, and now we're getting very close to the 50% retracement of this measured move to the downside. Now keep in mind that these are zones, so we're not going to say, oh, well, the S&P moved against 2620, so that resistance doesn't really matter. You really want it to go higher, I think, to take out the resistance, because this zone, this zone right here would be the first overhead, maybe the 2620 to the 2640 or 2650. And then if it gets up in this area, I think that would be the second test. But I think this rising 200-day moving average or excuse me, 20-day moving average is incredibly important because we're in, bear market rally mode, and bear market rallies can be strong and they can make us all forget that we are still in a bear market until they hit some overhead resistance and then just get slammed down. So just keep that in mind. This can get taken out, but everything that's above us, I think if it gets above and starts to move in this zone between 2640 and 2740, I think you want to start raising your stops on some of your more recent trades to make sure that you protect those in case of a double test, which I don't typically like to predict, but just based on corrections and past price action of bear markets, it is likely. I think it is highly likely. Doesn't mean it's going to happen. I'll always get surprised. The market is a humbling place, but it's just something to keep in mind. You want to have a plan. Always have a plan. So now let's go to the NASDAQ, because the NASDAQ has already punched through its 50-day moving average yesterday and is now, at least as of midday, is showing a little bit of a stalling action. And what that means is it's up. It is up as the market is moving higher, but stalling is if it's closing up, it's getting pushed down into the lower end of the range. That means there is some selling pressure being met. Now, this is the price. This is the excuse me. Let me show you the setting down here. The volume by price setting is, and you can do this with stocks, and you can throw this on a stock chart. And what this is this just goes to show you, in this zone right here, how much shares were traded. So you can see right here, right in this zone, the 2450 to, let's just say 7250 to 7450, you can see there were a ton of shares traded. Definitely a little bit more selling than buying. And then you can kind of see right here. So up here, when it gets above this level right here, kind of the 7450, which is a 200-day moving average, you can see that, there wasn't a lot of shares traded. And then once it breaks that level, then you can see the volume starts to definitely pick up in between these two zones. So could be resistance ahead. We're just going to have to wait and see. It did successfully punch through the 50-day moving average. The NASDAQ outperforming the S&P. That's what you want to see. This was the first level of resistance, but keep in mind that it broke above this right here one day and then got slammed down. So we're waiting to see if this stalling action continues throughout the day. And you can see there really wasn't a lot of, there's more buying right here than selling right here, and I assume that's on the upside, but it's just amazing to kind of see that during, all this price action, this 20% move, where all the volume is being traded, and it's being traded right in this zone. So, people could, bought right here, waiting to get back to break even. People could have short right here and then have a stop at break even, and that kind of pushes it down. So, I'm not going to predict. We're just kind of looking at the price action day by day just to take a look at it and try to be objective as we can. Now, this is the NASDAQ composite, and I did want to kind of go back to the NASDAQ real quick. There was something I forgot on that chart. So if we look down here, we're overbought in a bear market on the RSI 5. So you can see right here, we got overbought right here, and that was right around the 50-day moving average. You can see this point, and then it got slammed down to oversold all the way down here. Now we're back at overbought. We kind of got double overbought, and we'll see what happens. But sometimes, the overbought in a bear market, it's kind of like being oversold in a bull market. Like, it's the place to take the bet. So if you were to kind of want to, if you believe this was going to take another leg down, this would kind of be the area to place that bet, just based on the overbought, oversold, based on all this volume by price and all this overhead resistance in between this 50 and 200-day moving average. And keep in mind, we're really, until this 50-day moves back above the 200-day, in my opinion, we're still in a bear market, and bear market rallies can be incredibly strong. So I recommend that, you just raise your stops with it, you know, and just raise your stops, protect your profits. So you can see right here on the RSI 5, you know, we got oversold. We have not got overbought. Let me kind of raise this real quick, raise the order and update that so we can focus on the RSI 14 for a second. You can see we got overbought right here. And, you know, when you're in a bull market, let me get rid of this price by volume. Let me just kind of clean up the chart a little bit. So when you're in a bull market or an uptrend, you know, things kind of, if it goes overbought, it can stay overbought, and it doesn't really get oversold, at least on the RSI 14, right? And then once you get that first oversold, you kind of take a look at it, and what's interesting is it hasn't got overbought again. So in an uptrend, you can see that there was some support right around 40 on the RSI 14, and in a downtrend, there seems to be some at least short-term resistance right around 60 and 70 for a overbought. So you can just kind of pay attention right here, and it's funny how this is just kind of textbook right here. We're staying in the oversold area, and in an uptrend, we stay in the overbought area above 40. And then below 30 is obviously the extreme, and above 70 is the extreme. But you can just kind of, you know, play with this, and if you want the more signals, you shorten the RSI. The less signals, the more validated, but you know, you want to look at kind of a longer term RSI 14. So if we go back to the NASDAQ, we're looking at a zigzag chart here. Let me take this because that drives me nuts. So what this is right here, this zigzag chart, I have the zigzag setting set on 10. And what that means is every time the high to low, there is a high to low movement above 10%, whether to the upside or the downside, you're going to get that zigzag on the chart. So you can see right here, you know, since 2018, we've had 1, 2, 3, 4, 5, and this is probably 6 moves of 10% or greater to one way or the other. Right here in 2015, when we had a kind of a double dip nasty correction, you had 1, 2, 3, 4, 5, and then 6 was the winner. We're on 6 now. Now, I was actually looking at this zigzag chart, and I was making the case to myself, well, what if this was the first leg and just the rally overshot, and now this is the next leg? So that's kind of the bullish argument, that this is the second leg. I really don't think so, just because this was a strong uptrend. I think a strong uptrend kind of negates this correction right here, and then this price action undercut all this. So I think we start a new one. But again, look at these percentages, you know, coming out of bear markets, strong here, and I'll change it to 20, meaning a 20% zigzag. So you can see right here, the NASDAQ did have a bear market, even though the S&P 500 didn't in 2015. But you had, you know, coming off the lows, 126% move in the NASDAQ before another bear market started. And then coming off the lows in 2011, a 235% move before another bear market started. And now we'll kind of see, you know, how many zigzags we get right here. My point is, strong bull markets come out of nasty bear markets or nasty corrections. So we know that the price action of the NASDAQ doesn't really look like this, right? There is a lot of bobbing and weaving along the way, and you can see the price points, and I should probably hide those labels, but just to kind of show you, it's going to zigzag around the zigzag line. But so just don't get overly frustrated if we do take another leg down, because I'm trying to put a plan of action in front of you. Use those moving averages. They're not perfect. You know, they're not exact, but it's a plan. It is a plan to make sure that you protect your capital. And there's not, you know, most rallies aren't very strong unless they can stay above the 20-day moving average anyways. Okay, so now let's look at we're going to start at the 20-day moving average breadth, then we're going to move to the 50-day, the 200-day on the S&P 500. You know, we are in rally mode. You see 84% of stocks are above, in the S&P 500 are above their 20-day EMA. If we break it down by sectors, you can see that financials are strong at 92, technology at 89%, what's this, discretionary at 83, then you have industrials at 88, healthcare at 85, staples at 66, and you want that to be weaker because those are more defensive names, so you want the more aggressive, so that looks right. Energy at 93, which I think is the leader above right with financials. Probably just more of a dead cat bounce. Materials are kind of starting to consolidate a little bit, and then utilities, although now they're starting to maybe play a little bit of catch up the last couple of days as that line kind of looks straight up, but you can see 64%. So the good thing is, at least on this rally, the weaker, more defensive names, the staples and the utilities are the weakest. All right, once you start to see in this rally, if utilities, and you can see this line and all of a sudden start to get really strong and the other one's starting to curl, that means there is money rotating from the stronger sectors or the more aggressive sectors to the weaker sectors, and that's definitely another kind of piece of evidence that you need to pay attention to if we do get our next leg down. So the S&P 500 breadth, the percent above the 200-day, is still bear market. Only 33.4% of stocks in the S&P 500 are above their 200-day moving average. That is not good breadth. I mean, look up here when we were at the top, we were at around 80% breadth, 80% breadth. And you can't always have like 80%, above the 200-day moving average. Anything above 60% is an uptrend. But once you start getting north of 70%, then you're in a stronger market. But right now, the breadth just isn't there. And even if we go back to, you see right here, here's the double dip. Let me get rid of the volume on this chart because it is not doing any good. Oh, well, I'll just kind of leave it there. But you can kind of see right here the double dip in 2015, early 2016 in this correction. You can see that this rally, we did rally out of this and got kind of a breadth thrust above 60%. And then it just absolutely rolled over. Where is... I don't see that I even have volume on here. Volume overlay. Off. Let me see if I can get rid of that. Okay, there we go. So, and you can see kind of that you had kind of a double bottom right here, then a rally, and then it tried to consolidate. And I remember right here, this consolidation looked really, really bullish. It looked like a continuation higher and just could not do it, and then just failed and rolled over for another double bottom within a bigger double bottom. But my point is, you can get strong breadth thrust coming out of this. And if we kind of compare the breadth thrust to the price action, let me see if I can get a percentage change. So this percentage change was about a 13% move, and it went from, well, that doesn't really matter, but this leg up, or this bear market rally, more of a correction rally, it went up 13%, and that moved the breadth all the way up to above 60%. Now, if I compare that to say, okay, where are we at now? We're at an 11.5% move from the bottom compared to a 13% move on this leg. And our breadth is still way down here. So this, even though the price action is strong, we have a nice bounce off the bottom, this breadth seems weaker than this breadth. So I don't see that as a positive. I see that as a negative. I mean, if it was close, I would say, okay, that's looking kind of like the last one, but it's not. The breadth's still weak at 33%. And if you compare it to the last bear market rally or major correction rally, I think it should be higher based on this percentage move, So, again, we're just looking for evidence. It's just something to consider as we move along. Let's look at oil, gold, bonds, and the dollar. So let's just start with gold. So you can see gold right here, the GLD, or gold miners, GDX, is up a little bit right here. The GLD is looking strong. It's looking like it's trying to move higher. It broke out of this, but the miners, it kind of sold off a couple, I wouldn't say really sold off, but you know, they're pulling back and gold is headed higher. I think that means this rally could be suspect, but you know, that's kind of the bearish case that the miners are pulling back while gold really didn't move much. That'd be kind of the bearish case to say this could fail. And it's coming into this potential past support zone. They got touched 1, 2, 3, 4, 5, 6, 7, broke on the 8th time. And now it's trying to eat its way through all this price by volume action. So, you know, that probably wouldn't be a bad idea just to say, okay, what would the volume by price, if I added it on that chart, what would that do? So yeah, you can see that there is a lot of volume right in this area, not so much below it. So there could be a lot of overhead resistance as it is approaching. Let me draw this across this level, and so far it's been rejected. But again, I wouldn't say this a failure. We could make the bullish case for it that gold is headed higher, and it broke out of this double bottom, and now hasn't broke this the pivot yet of this support zone, this 2040 area. So, you know, we're probably going to have to wait a couple weeks or even another week or two to see which way this goes. Excuse me. You know, if we come down here, the miners were outperforming the metal, and now they're kind of been weakening the last few weeks, and over the last 2 months, you could say are performing in line. So when you look at the shorter term picture, it's getting weaker as gold is getting stronger. When you look at least 2 months, you could say it's been performing in line, but you know, that's something to watch. And then you have the dollar, which has an inverse relationship with gold, broke this trend line clear as day, and it could break this little mini down trend line for a continuation. So typically when the dollar goes up, gold goes down most of the time. So kind of, you know, I know that was a lot to soak in, but right now I think gold, I'm more, probably 2 weeks ago I would have said, hey, this is looking right, and now I'm thinking this could fail based on, you know, the weakness I'm seeing in miners relative to the metal, based on this overhead resistance price, and the potential dollar could start to rally again. So with that being said, let's go look at the dollar. And I drew this on the chart so you have a clear, you know, head and shoulders pattern right here. Breakout, pullback, consolidation, failed breakout, maybe an above average move to the downside, or excuse me, to the upside. So typically, this is something that Mark Pring teaches. A failed breakout or breakdown to one side is an above average move to the other side. So if it's a failed breakdown and it's a whipsaw and then it goes the other way, it could be an above average move the other way. Well, I think this was a failed breakdown, and then you had a breakout, a couple of candle, you could also call it a mini head and shoulders, came down, and it looked like it was going to roll over, and then the dollar is sitting here in this zone right here as well. So, you know, there could be some support, and, you know, we have I wonder if volume by price would work. I don't know if it will work on this one. No, it won't. I bet it would work on the UUP. But you can see, I'll bet anything, there's a lot of volume coming through this 95 to 95.5 area. A lot of that volume could be buyers, you know, the resistance, you know, support right here, resistance, broke above resistance, whipsaw to the downside, failed downside breakout, and now it turns into support for a long-term support. So the dollar and gold, they typically don't pan out that, you know, which way they're going to go for long-term moves in a couple days or a couple weeks. You kind of have to really look at long-term charts, and this is the weekly chart, but the last few weeks the dollar is coming off this bottom in the support zone. And on the flip side, the gold miners are pulling back of their resistance zone. I'm starting to kind of lean more towards the dollar is going to, you know, start to head higher, consolidate, and, you know, gold could have another, I mean, who knows? It hasn't done anything for years. Let's look at the TLT could be some support in here. Now, this is the TLT, the 20-year Treasury ETF. False breakout right here, clear as day, came back, undercut these lows, and you know, now is breaking out. And of course, most breakouts, you're breaking out of a 2-year downtrend line that could, you know, they surged above it. So to me, we're back on. And it's pulling back to retest this zone. And again, keep in mind, it's a zone. It's not, if it, you know, the support's at 119 and breaks, you know, 118.90, then, you know, the sky is falling. It's just a zone. Anywhere between kind of the 118.5 and the 120 could be the support zone. So just keep that in mind. But typically, and if you've seen John Murphy's intermarket analysis, you know, he talks about these cycles, and same thing with market pring, and they all say, you know, typically the bonds will fall anywhere from up to a year or more before stocks will and go into their bear market, but they will also bottom before the stocks do, and that's kind of showing to take shape right here. You had, you know, the bonds have been, you know, mostly because of yields, but they've been in a 2-year bear market. Now, they bottomed in November, and right now we have a bottom in stocks in December, and they've rallied out of this, and I would say they are completely out of their bear market. So are stocks to follow eventually? I don't know, but it's not as simple as, okay, you know, bonds bottomed and then a month later stocks are going to bottom. Sometimes they can take some time, but that relationship is proving right, just to go to show that bonds bottom before stocks and bonds have broken out before stocks as well. So, you know, what that means is we could obviously, you know, I think I'm trying to support the case that there's some major overhead resistance if I haven't already, and that, you know, it is likely we can at least, I'm not going to say retest the lows, but at least be in for some chop ahead. And if you want to know what chop looks like, chop suey, let's just go back to 2011 where, you know, this is what I mean when I say chop. You can just go sideways, just strong moves one way or the other, and just go nowhere for a couple months, digesting the correction or the bear market, going sideways, and then you get out of it. Shake out, boom, bull market. So that's what I mean when I say chop. I mean no man's land, going nowhere, volatility. Let's look at bonds, TLT. Let's look at the sector summary real quick. We're going to look at some industries, some ETFs, and some stocks. Let me go to the sector summary. So today, financials are up. I assume that has to do with earnings because banks are on deck. JP Morgan, I don't think met their guidance, but maybe some of the other banks have. I'm not typically one to say if a couple big stocks miss that the whole market's going to miss. I think that the guidance in the fourth quarter, the guidance was lowered so much in the S&P 500 stocks for earnings growth that we could have overshot the, you know, lowering the projections, which means we exceed the projections that we lowered. Now the earnings are starting to come around. Could not be as bad as we thought. So yeah, financials right here, Staples down here. That's good. Nothing wrong with that. We look at the last 1 week. Again, financials are kind of coming out of this. So the XLF is looking the strongest. Utilities, materials. You know, you want to see utilities towards the bottom, so that's cool. If I look at the last 1 month, so again, there's kind of a trend. You know, we looked the financial, the breadth on, at least on the 20-day moving average, was pretty strong for the financial sector. The 1 week, the 1 day, the 1 month financials, and I think most of this performance has been this week with the earnings, and the financials are up at bat. But like I said, all of these guidances could have been lowered in the fourth quarter and lowered so much that we could beat them. So utilities is selling off. And it's just interesting, you know, because I made the case about a month before I was talking about utilities. I was talking about, is it really worth it to invest in something more conservative and just wait it out? And to me, no, it's not, because even utilities can go down in a bear market. If we look at the last 3 months, utilities, I mean, they still have been down. You know, if you would have timed it perfectly, you'd probably still be down, even though REITs are up, so that's cool. But man, I mean, do you really want to risk that for one, 2% gain potential in a bear market? I don't. I'd just rather try to time the bottom, time some rallies, and make it up on the upside. That's just me. If we go to the 1 week on the industry summary. Now you have the strongest sectors, the communication, the discretionary, the financials. That's a sector. Now the sectors are broken down by industry. So you want to be at the strongest stocks and the strongest industries, and the strongest sectors. So we're going to look at the last 1 week to see where the money is flowing. So just looking at the leaders, specialty retailers, and this stuff is free on Stock Charts. So you can just kind of open this tab. And search it by this, and you can say, okay, Blue Apron, that's kind of a dollar stock, but Bed Bath & Beyond is up a lot. Barnes & Noble, Build-A-Bear Workshops, kind of some of these specialty retailers, they've had some pretty good moves in this correction, in this rally. So kind of keep an eye on that, 3.5%. Distilleries, I wonder if that's kind of front-loaded with some heavy stock. Yeah, it's front-loaded. One stock's kind of moving that, so we'll just. And I always look at that, when I look in here, I'm like, okay, if something is up the most, is it one or two stocks that maybe got bought out or bumped or something like that? Or is, their broad participation? So I can just ignore that. Okay, financials. This is, look, 555, broad participation in the financials. The banks, the investment services are looking pretty strong. And you can rank it by Scooter, which is the relative strength rating. Proprietary, you see Goldman Sachs is up a lot, Morgan Stanley, LPL, Charles Schwab. So just in the last 1 week, you've had a lot of money flowing into a lot of these, online brokers or money management or investment banks. So those are leading right now. Healthcare providers, let's kind of look at that and see if there's some broad participation. Yeah, I would say there is. A lot of these are penny stocks, are under $10. So what we could do is just kind of rank it by Scooter. Or I'll kind of go back and just look at all the green. There's a lot more green than there is red. So, right now you can look at, broker dealers. You can look at healthcare providers, to see if there's some good stuff in here. You can rank it by percentage change ranking, Scooter ranking, which is the relative strength ranking. So let's continue to go fishing. Paper, that's a big bump. I guarantee you that probably one or two stocks are moving that. Yeah, that is. So let's just kind of get rid of that. Just kind of get rid of some of these. REITs, nah. I mean, okay, they're up quite a bit. Let's kind of look, see. Yeah, there's broad participation in residential REITs. Okay, so we break it down by, because, these REITs or retail REITs, there's a big difference in performance in retail and residential. So I don't want to focus down here or even a broad basket of REITs. I want to focus in residential REITs, right? And then find the strongest stocks in those sectors. So residential REITs up 4%. Paper, we assume that. Healthcare providers up 4. A lot of financials. Right here probably is your honey hole where you could do some pretty good fishing. Keep an eye on the market. See if the market pulls back. See if there's any setups that you like. But this is probably a decent honey hole to fish in. ETF summary. Okay, so let me pull something else up. I'm kind of looking at another screen for a second. Okay. I'm going to pull up my ETF list. Let me drag this over here. All right, so I manually put these in here. I have an ETF list. Some of the most broad sectors, emerging markets, industry sectors, because what I like to do is I like to say, okay, out of 250 ETFs, that's a pretty good number. What's got the strongest relative strength rating in the last 3 months? And relative strength, all it means is it's outperforming the S&P 500. If it's outperforming, it's got a high relative strength, it still can go down just as long as it's going down a lot less than the S&P 500. So I rank it by 3 months because what I'm trying to do is I'm trying to catch trends early. Like if something's been beating up, like let's go right here to the Philippines. This is out of 250 ETFs, and there's a theme here. You can look at, here, let's look at weekly charts, and let me kind of go down here. Man, the Philippines hadn't done anything in 5-6 years. But now it's kind of surging out here, broke out this downtrend. The last several have failed, but it's the strongest. Look, Indonesia's up here at the top too. This one kind of looks a little better, I think, just because it has a history of when it breaks out, it can go on a multi-year run where it seems like the Philippines rolls over. But you can see right here, it just got its golden cross and is heading higher. Brazil, small cap, a lot of, and I'm showing you this, look at all, in the Brazil small cap, look at all this volume stepping in, and then a textbook pullback, bull flag, and then a breakout. It'll probably pull back again. You might want to consider that. So Brazil, South Africa, Latin America, Saudi Arabia, Argentina. Haven't looked at that one. So you can see that Argentina, right when the market started selling off, was selling off less. So you can see it was still going down, but the relative strength line was rising. And it sold off less and is doing well. Mexico, Chile. There is a U.S. ETF, the iShares Biotech, IBB. And this is probably because it just has such a strong snapback. Home construction is another one that was probably, this sold off, and it's never recovered when the market sold off in January. So probably a lot of value buying right there. And then you got some silver. Let's look at SLV. Just kind of looking at things. Look at what silver is doing, or at least this SLV right here. This broke out of this little pattern right here and is now consolidating above the 200-day moving average. Hadn't had 3 weeks above that in a year. Now this one failed. But if it hovers 3-4 weeks above the 200-day move, or the 40-week, excuse me, since this is a weekly chart, I mean, that's probably a sign that it could get out of this. So the point is not to really analyze all these charts. The point is to show you that there's some pockets of strength in emerging markets all of a sudden in the last 3 months. And this is something emerging markets also never recovered when the market sold off in January like the U.S. market did. It continued to go down. So it's way oversold. So there can be some really strong emerging markets that were being held back because of the emerging market bear market that's been going on for over a year. And now they're starting to come out. So just keep in mind that if you can find trends that have been in a downtrend for a long time and all of a sudden are showing signs of reversing, that reversing trend to the upside could last just as long if you're patient. So this is something to consider. Keeping an eye on some of those. You can take a snapshot of that. Now, I just kind of want to look at some setups. Let me take a sip of Powerade real quick. Keep me going, but just want to keep an eye on some setups. Just some stocks that I think kind of look interesting. And I know this one has been going up for a long time, Planet Fitness, but here's what I'm looking at. Like, it didn't really sell off when the market sold off. Like, it's held its 200-day moving average the whole time. There has been a ton of buying pressure on this rally in the new year. There's been a ton of accumulation. I don't think this stock is over. Now, you probably want to buy on an oversold, maybe closer to 200-day moving average, but the stock the relative strength line's been rising the whole time. It's showing that it's got more room to the upside. I'm not saying all these stocks are the strongest. I'm just, showing you what I think looks interesting. Yeti, I did put back on my watch list if, that's kind of hard to see. So, Yeti coolers, they have a ton of outdoor stuff like that. But, it has surged off the bottom 12 to 18, really gapped up on the 14th, which would have been on Monday due to a guidance revision upward. So this isn't anywhere near a buy point, but I think that if this pulls back and kind of consolidates, I think that could be one worth at least just kind of keeping an eye Save, Spirit Airlines, SAVE. This stock is looking right. If you look, let's look at the big picture first. Earnings 32% this year, year-over-year acceleration 45% next year. Pretty decent return on equity for an airline. That's pretty good. Very consistent sales growth. Spotty earnings, but apparently looking at the projections, it's looking like it's going to turn that around. But look, airlines, you know, this hasn't done well since in a long time, and is now trying to climb the right side of this 5-year base. Lots of weekly accumulation as it's climbing this, showing lots of relative strength in this bear market. Gapped up right here. I haven't investigated to see why it gapped up. And you know, it's pulling back. So this is something that looks kind of interesting. I don't really know if I like this entry right here, but I'm looking at stocks that are showing relative strength. You know, they say to invest in stocks that change the way you live. I think Roku is, you know, one of those, it just has a game-changing product for the future as far as cord cutting goes, you know, and basic cable. I think everybody I know has a Roku, or starting to, and, you know, then they can monetize it. But anyways, this was a darling stock, up 29 to 77. That's a 2.5 bagger, all the way down to 26. Man, I would have never guessed it got slaughtered this bad. You know, the bad earnings accelerated it, but there has been some major buying off the bottom. Moved from 26, is now at 40, gapped up right here on the 4th or on the 5th. Huge volume has now been creating this bear flag, just kind of right around this 50-day moving average, but you know, this is nasty, but I'm looking at, you know, this could be short covering. I don't think so. And I'm not saying that some of it isn't, but, you know, it came into this zone right here. Look, yeah, the breakout zone of the IPO, that zone found support, and now it came down here. Yes, it bypassed it a little bit, but then it came back off it. Could be some major support in the 28 to 30 area in this. Yes, this could, you know, this is going to be up a lot or down a lot, whatever the market does, but I think this could continue to be a winner for the next 5 years, if you can handle the volatility. And then EWS, I wanted to kind of look on this chart. This is a Brazil small cap. I sent this out a few weeks ago. You know, big surge off the bottom. We have apparently a new business-friendly president. I think he was elected right here. And then it consolidated, textbook bull flag, and then popped. It's, you know, if it gets oversold, look at the volume on this surge right here. If it gets oversold on an RSI 5, might not be a bad idea, because I think you got a lot of support in this 1375 area, and then you have the 200-day moving averages at 1392. So it's extended right now, but if it comes down into this area, I don't think it would be a bad trade to attempt with a stop under this. You never want to open the door for lower lows, but I hope this was helpful. Hope you got a lot out of it, and let me know if you have any questions.